Good evening, everyone. Thanks for joining us. We'll just do our usual quarterly strategy and stock picks event. Um, just our usual disclaimer. Uh, in terms of what we'll be presenting today, roughly the same thing, or roughly at least a similar schedule as the last quarterly stock picks. We'll run through the performance for the third quarter, um, run through some of the macro themes, investment themes, as well as finish off with some election specials and technical pulse. As usual, feel free to post any Q&As or any questions that you have in the Q&A tab below, and we'll try to get to it after the presentation is over, or at least after the slideshow presentation. Yeah, so just let's begin. Run through the market performance for the third quarter. Obviously, the slide over here, I put gold. It's really the high flyer in a sea of choppy waters. When you look at the different asset classes, gold definitely stands out the most. I mean, they more than doubled their performance for the year, and they are outperforming both the S&P 500 and Nasdaq, as well as other asset classes like bonds or commodities. We take a look at the I guess the bigger laggards. The Mag 7 companies were actually by far one of the biggest laggards. They were up only 2%, trailing the S&P 500's gain of 6%. And there's a big reason for this. I mean, obviously, a lot of investors started to rotate out of tech and big tech, especially, and this started towards the end of the second quarter. Yeah. Oh, sorry. And the main reason why gold did well is likely because they kind of have a inverse relationship to interest rates. So, as there's a lot of expectations, and Fed did actually cut interest rates, gold really spiked and ran quite heavy. When you look at currency-wise, the US dollar actually weakened versus all major currencies in the quarter. The biggest one here be the Japanese yen. And most should be quite familiar with the yen carry trade. But I mean, not just against the yen, but the Sing dollar as well strengthened 6% versus the US. So the sterling pound and euro is up 4%. The big reason for this was similar to why gold did so well. It's just interest rate cuts. So this is just an illustration of what sectors actually performed well and what didn't for the third quarter. Interest rate sensitive sectors continue to do well. So you've got your utilities and your real estate, which really has been battered quite badly. Utilities actually so far this year is the biggest outperformer, the best sector year to date. I think they're close to 30%. There are a few reasons for this. The biggest reason is because a lot of utility companies pay fairly high dividends, and so as your treasury yields start to drop, it really makes utilities much more attractive. Second reason is actually earnings for the utility sector is actually growing about in the mid-teens range year on year. So fairly significant growth for a sector that is fairly defensive. Then after these two sectors, you've got some of your cyclicals there, industrials, financials. Discretionary saw a huge boost because of interest rate cuts. While towards the tail end, most of your laggards, you got your semicons, your tech companies, energy, but energy is very fluctuating depending on it's heavily dependent on oil prices, and communications kind of running off the bottom. So it was really growth at the bottom, cyclicals in the middle, and then I guess more defensives or interest rate sensitives at the top. So we like to take a look at this chart. It's just a concentration of the Mag 7 compared to the rest of S&P 500 in terms of market cap. You can see towards the end of second quarter, this number was at 35% almost. So it's kind of peaking, and has come down fairly significantly over the last quarter. Which is I guess in some sense it's quite healthy. Seeing some sort of broadening out amongst the remaining 493 companies in the S&P 500. In terms of valuations for the Mag 7, they're still below their long-term average, although so as a sector, we still think there is a lot of upside to it, although most of this would be more heavily weighted towards some of your winners like Google as well as Nvidia. Because actually most of the Mag 7 companies have actually increased, in terms of valuations, in terms of forward multiples, quite significantly. When we look at the overall market versus the Mag 7, you can start this is kind of another chart to show some illustration of the S&P 500's EPS growth, which is in orange, while the Mag 7, which is in blue. It's quite clear over the last few quarters, the Mag 7 is actually decelerating in growth, while there's sort of this pickup in growth for the S&P 500 overall. So it kind of suggests that at least earnings growth is starting to broaden out, starting to be a little bit more healthy for the overall market. In terms of valuations, the S&P is still really pushing into overvalued territory. Is trading at almost 25 times. And there's more than one standard. It's almost two standard deviations away from its average. The caveat here is that, with interest rates coming down, could likely see this continuing, at least staying in overvalued territory, at least compared to historical numbers. You see the last time that interest rates actually cut, which is in the red box over here, 2019 all the way until middle of 2020, 2021. The valuations actually expanded about 3 or 4 standard deviations. So it won't be unusual in this kind of interest rate environment where it's, I guess, easing policies and more for growth oriented companies, that valuations will remain fairly high for a significant period. A similar story for the Nasdaq, trading at 31 times. So very similar chart to the S&P 500. We look at where there could be some opportunities, if you don't really want to take a look at tech and some of the high growth companies. We think consumer staples looks like a pretty good opportunity, even though they have rallied quite a bit in the last couple of months. It's still trading slightly below its or around its 10-year average of 28 times. Staples typically offers more stable growth and are generally least affected by recessions, which is still a slight worry for a lot of investors right now. Especially with a lot of people, a lot of investors being a little bit more defensive, this could be a sector to look at. Utilities as well. They continue to be, even though they have run up quite significantly, we still think that they're fairly valued. They still got a little bit more to run, especially if rates cuts continue, gradual rate cuts continue onwards. The main reasons for this is it's just their dividend yield, plus they're still growing in terms of growing their earnings, growing their margins. And last but not least, real estate, which has been the laggard for most of, I guess, since the pandemic. You can see from 2020 to 2022, valuations have really crumbled. But now that interest rates are coming down a little bit, investor interest has slowly but surely flowed back. It used to be, with high interest rates, low occupancy rates, high refinancing costs, didn't really suit a lot of the real estate market and a lot of the REITs and real estate companies. But this is kind of improving a little bit with rates coming down. The lower rates should also help to alleviate some of the refinancing concerns within the sector. When you look at treasuries versus the S&P 500 in terms of earnings yield essentially is the inverse of the PE, so it's 1 over the PE ratio. Right now, it's fairly on par, the S&P versus the US 10-year Treasury. And we just think that treasuries still look fairly attractive in terms of valuations. Although when we think about the broader environment that we're in, where there's a little bit of easing policies, monetary easing policies, that really actually benefit equities a little bit more than treasuries and bonds, especially as treasuries start to come down. So it's just a recap of our stock picks for this quarter that was past that we had in our last event. So actually, I guess we didn't really do too well. Most of the counters were slightly negative. Alphabet, the largest one, mainly because of significant concerns over their DOJ antitrust loss. Uh, and so investors are just very concerned about what happened, whether the company will be broken up or not. Just a little bit of overhang, a bit of uncertainty that the market just doesn't really like. So we move on to some of the macro themes. The key one, inflation, it's quite widely known inflation is fairly under control. I think you look at inflation, core inflation is the blue line over here, 2.7%. When you look at goods, it's in this inflationary environment, so they're fairly back to pre-pandemic levels. The only reason why core inflation hasn't really come down is because services remain fairly elevated. They're around 4% a number, whereas when you look at pre-pandemic, it's half of that. It's about 2%, 2-ish%. The big news for the quarter, the Fed cut 50 basis points. The first time it cut after holding for slightly over a year, I believe. I mentioned, it was gaining enough confidence that inflation was under control, which is good news for a lot of industries. But if you think about it, it's kind of a double-edged sword, because it kind of means that the whole economy is actually slowing down. That's why the Fed needs to cut to stimulate the economy a little bit. That being said, the rates still remain fairly elevated. 4.8%. It's not an environment that markets have seen for almost 20 years now. So even though the Fed has cut, they're still fairly elevated rates. Then the second question is how many rate cuts will we get? Right, so we already had essentially 2 rate cuts in the September meeting. And what the market is pricing is for another 2 to 3 rate cuts for the rest of 2024. So either 1.5, 1 to 2 in November and another one in December, which is actually below what the Fed is projecting for this year. So it is an interesting chart. The Fed is projecting for the next couple of years this very gradual rate cutting scheme. 4 rate cuts in 2025 and another 3 rate cuts in 2026, whereas the market is pricing significant rate cuts in the near term before leveling out in the middle to the back end of 2025. I think the key thing here is the market is really worried about jobs number and about a fast slowing economy. That's why they price in such significant rate cuts so early on. It's a little bit worrying because the Fed pivot usually leads to markets dropping. In the last 3 times that the Fed pivot very quickly, markets drop quite significantly. Obviously, there are several differences and reasons for this. The last 3 times we really entered into significant recessions, or maybe not so much for COVID, but the dot-com crash and then the GFC. And that really caused the Fed to cut rates quite significantly. So what would really be more positive for the overall economy and for the stock market is if the Fed begins to gradually cut rates like they expect to, which I showed in the previous chart. Then we could continue to see S&P just continue to climb and make all-time highs. Whereas if they start to really aggressively cut rates, then you might see, even though in theory it's great for the economy and great for the stock market, you probably might see a big drawdown because it probably will spook investors quite significantly. So we look at the labor market in the US, because there are 2 main things that the Fed is looking at. One is inflation, and 2 is the labor market. We're starting to see the labor market slow quite significantly. You look at your hourly wage growth continues to moderate a little bit, although there was a bit of a tick up in the last couple of months reading. So it's down to 4.7%, fairly close to its long-term average of 3%. But this is down significantly from the pandemic peak of 8-9%. Unemployment as well ticked up for the most of the third quarter until the last September reading. Right now, unemployment is about 4.1%, so it's still fairly healthy. Typically, anything once it starts creeping above 5%, then plus weakening macro conditions, that's a fairly good indicator of impending recession. But for right now, yeah, unemployment still is fairly healthy. When we look at this chart, it's your job openings to unemployed persons ratio. So typically this average has been around 0.7, 0.8 times, so that there usually has been more job seekers and job openings. But since early 2022, that's been the total opposite. Have been significantly more job openings than unemployed persons. But this has come down quite significantly. So it's always about on par, very close to reaching a sort of demand supply equilibrium for the labor market, which is healthier. Although we would like to see this level at least be maintained and not drop significantly further, because that could indicate significant weakness in the economy. Because essentially, you don't have that many jobs, you have more unemployment, unemployed people, less spending, less stimulation for the economy. When we take a look at the US consumer, we start to see a little bit of some cracks appearing, a little bit worrying, but I guess take it with a pinch of salt. The good news is that the economy doesn't equal the stock markets. So even though I guess an underperforming economy could still propel markets higher if outlook is positive. So we look at the consumer spending. We mainly look at this retail sales number, which is excluding motor vehicles. We see that consumer spending is continuing to moderate. So it's about 3%, growing about 3% year on year. It's quite a significant slowdown. It was not too long ago in 2022, 2023, this number was above 10%. And so it's a little bit concerning that if this consumer spending level remains under the average at this like 2-3% level for too long. At the same time, savings rates continue to steadily decline. Inflation, even though it is moderating a little bit, is still slightly elevated compared to historical norms. Still eating away at people's savings, and that's quite evident in the chart here. Meanwhile, this is a little bit more worrying. Credit card debt continues to climb to an all-time high of about 1.1 trillion US dollars. So it's a little bit of a precarious position because if your unemployment rate continues to rise and credit card debt continues to rise as well, the likelihood is that maybe some of these people that are unemployed won't be able to pay off the debts. Then if you've got debt holders, not really good position for some of the debt holders if this happens. But overall, wouldn't really be too concerned if unemployment remains fairly low. So then we move into some of the investment themes. The first theme, is still AI. AI has been a big part of investment themes across the world for the last year and a half. When we take a look at AI, or at least the AI trade, we still think Nvidia is king, even though it's run up 150% this year. There's several reasons why. Firstly, big spenders continue to increase their AI spending. When you look at this chart, it's mainly the hyperscalers. So even though I put a big tech, it's essentially Apple, Amazon, Microsoft, Google, as well as Meta. They continue to pump in significant amounts of money into their capex spending to build out new AI infrastructure. I expect this number to hit, close to 250, 300 billion next year, given the commentary from some of these companies. So essentially, if you want to follow the money, right? The interesting thing is that about 50% of all AI spending goes to Nvidia because it goes to GPUs. So if you just follow the money, you expect 250 billion in spending from just these four guys next year. Basically, take 50% cut of that for Nvidia's revenue. Got quite a sizable sum, and just from these four customers alone. And it's quite interesting because each GPU that Nvidia sells, at least for its AI GPUs, costs. I believe the Hopper costs about 30,000, which is their older model, and then the newer Blackwell for next that's going to be released either in the fourth quarter or begin to ship in the fourth quarter of this year or early 2025. Costs slightly closer to to 40,000. So you've got this like 35% increase in cost per GPU for NVIDIA. So the growth story for NVIDIA remains unchanged. Still think it's going to be fairly robust. Even though if you look at the line chart, the orange line here, it's come down quite a bit from 200+% growth to about 140, 150%. Still very high. We think that it's natural for this to come down, but the dollar value and the dollar revenues that they earn will continue to grow. And this is mainly because there's so much commentary and so much about positive demand for its Blackwell accelerator systems. And you've got commentary from all of the customers saying they're still going to be spending more money. Even along the supply chain, you're seeing a lot of positive data points as well. So everyone's still talking about AI. Everyone's still building out their AI capabilities. And as they continue to do so, they still need the hardware. That's kind of where NVIDIA comes in at. They still have about 90% market share for all AI accelerators. The only one that really comes close would be AMD, the small extent Intel. Margins for them remain extremely high, 75%. We do see a little bit more margin upside for next year, especially if is dominated by Blackwell, because in higher prices it doesn't really cost them 30% more to manufacture each of the Blackwell GPUs versus the Hopper. So we still do see a little bit of upside, maybe like 1 percentage point. So not saying it's not that big, but definitely margins have some potential to expand. At the same time, when you look at the value of the company, they're trading at about 30 times for PE, so it's well below its 10-year average, and essentially it's trading at the same price or slightly below the Nasdaq right now. Maybe not after the last week's gain, but at the end of the third quarter, we thought 30 times for a company that's expected to grow calendar year 2025 earnings, about 100x, 100%. It's still a lot of value there. And so that's kind of why we're still very positive and optimistic about NVIDIA. I still think there's a lot of upside due to more upwards earnings revisions, especially as the fourth quarter comes around, and faster growth due to stronger demand. So we have a buy rating on NVIDIA with the target price of 155. So our next investment theme, we're taking a look at digital ads. I think there's quite a bit of favorable pricing right now. And at the same time, fourth quarter is typically a good quarter for digital advertising companies. We found there was kind of a fairly strong correlation between consumer sentiment and the stock price of Google. They're the key digital advertiser aside from Meta. As consumer sentiment continues to increase, Google stock price increases, and then when sentiment decreases, Google stock price decreases as well. There's a little bit of a lag time, maybe 2 to 3 months. But typically you can see this trend, it just goes up, down, and it kind of follows it. The key theory here is that, if sentiment is positive, these people are willing to spend more. Advertisers want to capture more of this spending, so they'll advertise more. And the way that advertising works is it's basically a marketplace of supply and demand. There's only a set supply of advertising space, and if consumer sentiment is climbing, and there's only a set limited supply while demand continues to increase, then pricing goes up. But on the flip side, if sentiment is weakening, then pricing goes down. And so that's really what we're seeing for and why we think digital ads is still going to be very positive in the fourth quarter. At the same time, election years also tend to be very good for digital ads, and that's just more political spending. You can see in the shaded areas here, both Meta as well as Google continue to climb over the last couple of election cycles. So this is just a chart of digital ad pricing. You can see quite clearly from the beginning of 2023, the change in ad prices has improved. It's been positive for most of 2024. We think that this story will continue moving forward. CPM, we've had about 3 quarters of positive CPM growth. I think two key reasons for this: consumer spending as well, resilient consumer spending as well as uh, more political campaign spending as well. On a separate note, generative AI is also helping to improve a lot of the efficiency of advertisements. So making targeting significantly better. And this is really driving up an increase in CPMs, which are ad prices. So for Alphabet, which is our key, I guess the king of ads, right? We think Alphabet continues to climb, continues to build its revenue quite steadily. They're essentially growing at a fairly, uh, 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 I guess it's not like super exciting, but it's a mid-teens to low 20% year on year in terms of their revenue growth, which is fairly steady. Ad revenues continue to improve because of growth in both ad prices as well as ad impressions. Plus, you've got a lot of AI integration that's driving just more value for advertisers, driving more monetization for a lot of its products. So in terms of that, we think digital advertising still has a long way to run. They're still fairly in terms of pricing, they're still fairly low in a lot of the developing markets, and that's predominantly where we think there's a lot of value. Aside from digital advertising, they've also got an additional revenue driver from their Google Cloud business, which is the third largest cloud business in the world. They are benefiting quite heavily from a lot of their generative AI products. A lot of startups lean on Google Cloud to a lot of AI startups in particular lean on Google Cloud to perform a lot of the training and inferencing. And then it's really going to be, I guess, a second growth driver for the next few years. In terms of their cost structure, they continue to be fairly lean. Margins continue to improve as well, which is positive for you've got growth on both the top line as well as operating line in your bottom line, which is really all a company can ask for. For Google, we also think it's kind of a value play. For valuations right now, about 17 times price to earnings, 2025 price to earnings. Is well below its average of about 22 times, I believe. And well below the Nasdaq's current valuation of the 30 times for PE. So we think that it is a solid company. Valuations relatively cheap compared to historicals. So that's why we think we're very positive on Alphabet. So we have a buy rating as well with target price of $205 US, and these target price were given after their second quarter earnings call. Yeah, so I think that's all for me for now. Maybe hand it over to Ambrish to continue on with the rest of the presentations. Thank you.
Thank you, John, and good evening, everyone. So our next investment theme is that consumer technology stocks like PayPal, they may benefit from rate cuts. Next slide, please. So our stock pick for the fourth quarter of 2024 is PayPal. So PayPal, it's basically a digital payments company and it has a global presence across about 200 countries. And it benefits through its two-sided network effects, basically mainly because it has a large customer base it serves both consumers and merchants as well. So they have a total active user base of about 430 million. And PayPal, it basically generates its revenues through charging its users a small transaction fees on the payment volumes that have been processed on its platforms. And if we look at the chart, the payment volumes on PayPal's platform, it had significantly dropped in 2022. And we believe that this is mainly because of the slowdown in e-commerce or online shopping after the COVID-19 boom, and also because of the rising inflation and economic uncertainty. However, the payment volumes, it accelerated in the second half of 2023, and it remained resilient or healthy throughout the 2024. And going forward for the fourth quarter, we believe that the payment volumes should accelerate from here on, mainly because of the interest rate cuts. It should lead to increased consumer spending on its platform, and as a result, it could generate higher transaction fees. And secondly, PayPal, it's also witnessing the number of active users, it has remained flat on a year-over-year basis, but it's witnessing higher customer engagement on its platform, mainly because of continuous product innovations. Like recently, it had introduced integration of passkeys as well as Fastlane by PayPal, which basically enhances the guest checkout process. And so basically the engagement, it increased by about 11% in the second quarter, and we expect that to continue. And in addition, in terms of costs, margins, the margins have been expanding. So in the second quarter, it expanded by about 200 basis point to about 19%. And this is mainly because it's continuing to focus on its improving its profitability through a higher operating leverage, particularly through job layoffs. So earlier this year, it had said that it's about it's laying off about 9% of its total workforce, and as a result of this, its margins have been expanding. And we also believe that PayPal, it's a value play, mainly because it's currently trading at about 16 times forward price to earnings ratio, as compared to 23 or 24 times for the S&P 500. So overall, we have a buy recommendation for PayPal and a target price of $80. And as a side note, we had this issued this target price based on the second quarter results, and it has already reached our target price this week, and we tend to update it when the company will announce their third quarter 2024 results by the end of this month. So that's all for me. Would now like to pass it on to Glenn for banking outlook.
Yeah, thanks, Ambrish. Yep. So I'll be doing a bit of the US banking macro. So, and also, looking at the review and the recap of the bank's results the previous quarter, and also what to expect for the next quarter and for the rest of the year. So the main talking point for the US banks, and I think for any bank or I think financial institution now, would be the effect of the rate cuts. Right. So looking at the second quarter results, sort of this review, we can see that net interest income and net interest margin has also continued to decline in tandem with the rates sort of being flattish, and now it has finally dropped. And this is mainly due to the higher cost of funds as well as the asset yield growth stagnation. So the banks aren't able to get as much money or value from the assets that they have, or deposits that they have. And however, the banks still have shown quite good growth across the board. If you look at an average, it's mainly due to the non-interest income growth, particularly looking at the investment banking. So investment banking was very strong, and we are continuing to expect that this will be the growth driver for the banks going into the third as well as into the fourth quarter of this year. Another point to look at would be the provisions change. Across the board, you can see that it's increased, as John was speaking about earlier, about the credit card debt being at a rather high elevated levels, and this has reflected to the debtors, which of course the banks being the largest debtors, like the largest lenders of money and credit cards. So they were affected by it. This increase in provisions was mainly due to the higher credit card allowances that they had to give out. However, overall, you can see that PATMI was quite strong. It grew quite well, 25% for JP Morgan. Bank of America and Wells Fargo did not do as well. It was quite flat. I think it was mainly due to their investment banking as well, not doing as well, and also their net interest income dipped a bit more than expected. As for Citi, they have done quite a good, strong recovery. I think that they managed to control their costs a bit, which is why they had a 10% growth year on year, at least in their PATMI. Now, moving on to the next slide. So I'll go into more detail, right, into the bank's different segments and what do we expect, going forward. So next slide. Yeah, we're looking at the net interest income and net interest margins. This is the largest, revenue segment for all of the banks. So this is basically just the net interest income for the banks versus the Fed rates as well as their NIMs. You can see that the Fed rates being the red line here, there isn't much movement. If you look, I've actually pushed it all the way until the most current, which you have is September. This is mainly due to it being an average. So I took a 3-month average because we are plotting it against the quarterly results for the banks. Hence, you can see that it's a very slight decline. And however, NIMs have also been sort of this flat range, and we do expect it to remain flat or even go down even more so going into the next few quarters once the rate cuts have been fully felt, I guess, by the banks. And you can see it reflected in the net interest income, which is the blue bars we have here. So there was this huge spike up initially when rates were hiked, but now the banks are feeling the pinch because of their cost of funds. So next, moving on to the next slide, I'll be talking more about how the cost of funds have been impacting the banks, and why they aren't able to make as much net interest income or net interest, or as much as a healthy net interest margins as compared to the initial part where rates were increased. So what we can see here, the orange line being the asset repricing, and the red line being the cost of funds. So asset repricing, you can take it like something like a bit like the asset yield or the loan yield that they get. And cost of funds, it's how much they have to pay out the deposits. So it's quite different from Singapore market, because Singapore is very there's only 3 local banks, right? But in the US, there are like so many more banks. Hence, they have to be very aggressive with how much they are giving out in terms of their deposit prices in order to sort of retain the customer and to retain their deposits base. So we can see initially, as I mentioned earlier, when the rates were just like spiked up very sharply, we can see that the asset repricing was also very high. And the difference, you see the gap in between the orange and the red line in, let's say, 2022, it's a very big gap, because the cost of funds, it had to, it sort of like was slower to catch up with the rates, whereas when they reprice an asset, when they reprice a loan, it's immediate. Hence, you can see this spike up in their net interest margins, asset repricing, but cost of funds was more of like a slow, stable growth. However, recently, what we have seen in the last few quarters is that the cost of funds have started to outpace the growth in the asset repricing, because they have to eventually bring it down, right, in order to sort of retain the customer. And accordingly, you can see the net interest margins have also stagnated. But what is I guess what is good and what we have seen is that the cost of funds have finally, or more like the cost of funds have sort of slowed down, and asset repricing has caught back up slightly. So we're more at like a parity now. So this will be beneficial for the banks, because moving forward, they will be able to price down their funds, their cost of funds even further, due to they can use the excuse that the rate cuts have come in, hence they can lower their cost of fund pricing. Whereas asset repricing, they can maybe hold it slightly stable for the time being. So they're trying to do like an inverse of what they have done when the rates were hiked. Yeah, so this is a good point for the banks. We might see net interest margins stabilize. We just hope that it doesn't go down further. Now, moving on to the next slide. This is what will be supporting the bank's earnings. Previously I spoke about the net interest margins, net interest income. That's probably not going to move much. But what will spike up would be the non-interest income, particularly if you're looking at investment banking fees, as well as their fee and wealth management income, how they use the assets under management, or AUM, that they have. And now they're better able to put that AUM that they have out there to sort of get a better margins on their assets under management. And also the investment banking fees are still expected to have a double-digit growth, or even higher than that. I think JP Morgan came out strongly to say that, yeah, we're expecting way more than double-digit, like 30-40% kind of growth for the next few quarters. Yeah, so this will be the main growth driver, at least for the US banks. Now, moving on to the last slide. I'm sorry, next slide. Yeah. So the next slide, loans growth, that's another big factor for the banks. We haven't seen it grow much. This chart here is just the nominal GDP against the loans. So what we don't want to see is that the loans growth are outpacing the GDP growth, because that would mean that the banks are over-lending, and that's not a good sign, because it means that if you look at 2008, right, that was leading up to the GFC, the global financial crisis, the loans growth way outpaced the GDP, which is maybe a sort of a way we can see like a recession was coming. So what we are seeing currently is that the loans growth, while it's still picking up, it's still slower than the GDP growth. And also with the rate cuts coming in, we could expect this thing to do a U-turn and come back up to I guess mid-single digit, or we'll probably see mid-single digit levels, hopefully going into the next few quarters when the rate cuts eventually fully come in. Yeah, so that's all I have for the US banks and the banking sector. I'll now hand it over to Helena for her initiation. Thank you.
Thank you, Glenn. We've recently initiated coverage on Shopify. So in case you don't know the company, just a short introduction. So Shopify was founded in 2006. It's a Canadian multinational e-commerce company. It functions more as a software as a service platform. So it's kind of providing merchants with tools to create customizable online stores. So Shopify manages everything from product listing and payments to shipping. Since they are one of the most widely used e-commerce platform globally. They serve over 1.75 million merchants across 175 countries. So for Shopify, their business model is built on two main revenue segments. One is subscription solution, and another is merchant solution. Subscription solution, they generate revenue from consumers' fees to access the Shopify's e-commerce platform. So Shopify offers a range of subscription plan, each with different pricing tiers that caters to businesses of various sizes and needs. The 5-year CAGR of the segment is approximately 32%. This kind of indicates their successful scaling effect and effective response to the growing demand for the e-commerce. The second segment is the merchant solution. So merchant solution represents the more faster growing segment of Shopify's revenue. This segment captures revenue from merchants' various services once they begin selling product on the platform. So merchant solution revenue, they show a very strong and consistent growth over the last 5 years, with a CAGR of approximately 554%. So this accelerated growth kind of highlight their shift from solely an e-commerce platform provider to a more comprehensive service provider supporting merchants throughout the entire business. In terms of the investment merit, we believe we essentially like about Shopify because of the following reason. The first is Shopify has positioned itself as the leading e-commerce enabler by offering an all-in platform. So their comprehensive suite of services definitely cater to businesses of all sizes. So their ability to streamline the entire process has made it the global go-to platform for all the merchants. And we think as the e-commerce sector continues to experience rapid growth and more consumers start shifting to online shopping, Shopify's consumer-aligned revenue model definitely ensure that it will capture a growing share of the market from the traditional retail market. The second thing we like about it is Shopify payment. The Shopify payment has been driving Shopify's revenue growth. With the ongoing boom in e-commerce, the demand for streamlined, efficient payment is rising rapidly. So that definitely positions Shopify at the forefront of this trend. Shopify payment has been the largest driver of the company's merchant solution revenue. Its penetration of GMV have significantly increased from 40% in FY18 to 61% in the last quarter. We anticipate the increasing reliance on online transaction across global market to continue to fuel Shopify's revenue growth. Shopify payment is a built-in payment gateway. So it's designed to work seamlessly without any requiring third-party integration, unlike its competitors like PayPal or Square. The last thing we like about Shopify is the increased monetization for a subscription solution. So it kind of shows their pricing power. For the first time in 12 years, they have begun increasing monetization within the subscription by raising its pricing tiers almost 30% on average. Additionally, there has been a growing number of clients opting for the higher margin Shopify Plus plan, which now accounts for 31% of their monthly recurring revenue, which is up from the 22% in FY18. So we expect Shopify Plus to continue expanding, particularly as more global large merchants start to join the platform. So that definitely contribute to the increased profitability in the subscription solution, boosting monetization essential for Shopify. So particularly as it's reaching its turning point in profitability in FY23. So with all that, we initiate our coverage on Shopify with a buy rating with a price target of $105. That's all from me. Now I pass my time to my colleague to talk about US election.
Thanks, Helena. I think I'll just talk about the performance of the S&P 500 during election years. So this year, we have seen a very strong year for the S&P 500. So the chart actually shows the S&P 500 performance this year as compared to average election years. For this year, it's represented in orange, for the average election year is in blue. So you can see that during average election years, currently at this point in about October, we are usually up about 5%, and year to date will be up about 8%. But for this year, we are currently up about 20%. So that's actually a very strong outperformance as compared to the average election year. Next slide. Yeah, then next one, to continue on, we are likely to see a seasonally strong fourth quarter election years as well. So as we head into the last 3 months of the year, typically in October, we see a slight drawdown of about 0.3%. And then in November, we see a positive return of about 1.1%, in December about 1.5%. And the probability of it being a positive month in October and November is about 60%, and December is about close to 80%. So we are likely to see a strong end to the year based on seasonality. Next slide. Yeah, then next slide, please. Yeah, so for outlook for the Nasdaq, it's currently consolidating within an ascending broadening wedge, highlighted in blue. So recently, it's just been consolidating sideways around the 18,000 level. However, we see the Nasdaq to actually continue to push higher through the last quarter of this year, with our fourth quarter target about 18,500, which is about the current year to date high level, to about 19,500 area. Next slide. Yeah, as for S&P, it's still performing strongly as well. Recently, we've seen a breakout above the 5,670 resistance level, and price is currently consolidating above it. So we do see it extending the bullish momentum this year in the last quarter to potentially reach 5,900 to about 6,000 area to actually retest the trendline resistance in blue. Yeah. Next slide. Yeah, so that's just all from me. I'll hand over time to Jonathan to talk about our stocks coverage. Thanks.
Yeah, thanks, Ian. So it's just a slide of essentially what stocks that we cover. We've got about 20 plus names here. Mostly tech, some of the banks. Okay, so in conclusion, the rate cuts basically does to favor sectors like continue to favor sectors like utilities as well as real estate. I guess some of the staples, but they should also benefit big tech. It's more of a risk on sentiment. We think more money will pour into big tech, which has had quite a lackluster third quarter. We are a little bit cautious at the same time because we also kind of closely look following the economy and the slowing growth of the economy. Although we still believe that we are in a secular bull market. AI is the main driver right now. It has been for a year or so. Main driver of revenue, especially for tech companies as well as for margin growth because of efficiency gains that companies have been able to leverage. The good news is that we still believe that we are still in the early innings of it. We've still got at least 2 to 3 years to go. So we've weathered quite a choppy third quarter. We're looking to finish strongly for the rest of 2024. I think not just historical trends, but at the same time, a broadening of earnings growth amongst other 493 companies in the S&P 500. At the same time, seems to be more positive earnings revisions for a lot of these companies, which should be more positive towards at least for the fourth quarter of this year, moving into next year. So with that, we'll come to the end of our presentation. Maybe you can jump into the Q&A. We'll just you're able to upvote some of them, so we'll just take if there are any upvotes, we'll take priority on those. But if not, maybe I can start this question here. We'll do some of the TA later on. You'll leave 10-15 minutes for Zine to run some of the TA. So the first question here is, the latest news of the DOJ mulling a breakup of Google, will it be bad for the stock? So our view is that we don't think so. That's the worst case, right? But for the entities, and the main point is to actually just break up to take out their digital advertising business and then separate it from the rest. We think even if they run as a separate entity, maybe it might be slightly less efficient, but the business model will be quite unchanged. They'll probably still be by far the leader in the digital advertising space, quite a bit ahead of Meta. So we think it's more of, we think yes, it's a concern, but we don't really put that much stock into it. So the higher likelihood would just be a really big fine, we think. And maybe some restrictions here and there, but I think breaking up a company as big as Google will be quite difficult. I think what will likely happen is that if they really want to push through with this, Google will just arm themselves with a bunch of lawyers and delay this for as long as possible, which we've seen in the past with some other companies. Yeah. So initially, upon the news, it was bad for the stock. We saw quite a bit of a sell-off, and the stock has kind of been hovering at around those levels ever since, waiting for a catalyst to kind of push it upwards. There's another question here, what can we expect for Tesla's Robotaxi Day? Yeah, so I think, well, first of all, this Robotaxi Day was delayed a few weeks, which is quite the norm for Tesla nowadays. I think what you should expect is more, I guess, a sales pitch rather than with some guidelines as to with some proper timelines as to when Robotaxi could really be deployed and when monetization will start flowing in. But the likelihood is that it wouldn't be anything that exciting that the company hasn't already said. So we take it as more of a sales event, similar to some of the other investor events that Meta just had with their Connect 2024. Just something to showcase maybe some of their future products. But we also do think we could expect Tesla to officially I won't say launch, but officially name their new low cost EV, which should be named Model 2, and maybe another product. Yeah. So that'll be all for the Robotaxi Day, essentially. I think with that, maybe I'll hand it over to Ambrish to answer a few questions first. Thank you.
Thank you, John. So I have two questions for me. PayPal target price $80. It is currently trading at $81. Why is it a buy? So basically, we had issued this recommendation after the company had announced its second quarter results in early August. So going forward, we would maintain our buy recommendation mainly because the growth would be accelerating for PayPal, as well as the margins have been expanding and it's still a value play. So overall, we would maintain our buy, but we would update our target price after the company would announce its third quarter results, as we usually update our estimates and come up with a revised target price after the company's quarterly results. So the second question, how does PayPal compare with Visa? So if we look at the business models of PayPal, it's basically online, it's into the online or digital payments transactions, whereas Visa, it's a card-based processing payment gateway. So overall, in terms of the volumes processed in the second quarter, the PayPal or in the trailing 12 months, PayPal has about transacted about payment volume of about 1.6 trillion, whereas in terms for Visa, it has about 15.5 trillion payment transactions. Whereas the revenue growth rate for PayPal and Visa, it's still more or less same, like about both are growing at about high single digits, like 9%. But in terms of the margins, PayPal, it's significantly lower. It generates about in the second quarter, it had generated about net margin of about 15% as compared to like Visa about 40 to 50%. And this is mainly because PayPal, it reinvests into a business, like into growth initiatives. So in terms of earnings, Visa would be a better play. Whereas if you look at the valuations, PayPal, it's trading at a significantly low as compared to Visa. So PayPal, it's trading at about 16 times forward PE, whereas Visa, it's trading at about 25 times forward PE. So that
Oops, I think we seem to have lost Ambrish, and he dropped off. Maybe I can just take this one question here.
Okay.
Yeah, and then I'll pass it to Glenn. There's a question here, what are your top picks on defense stocks? Yeah, so we don't really cover any defense stocks, but, obviously with the war going on in Israel and Middle East, and Ukraine and Russia, defense companies have actually had a really good time. I think you just take a pick of any of the top guys, RTX, L3 Harris, Lockheed, they manufacture a lot of the munitions, a lot of the missiles, that they'll continue to do well in this environment just because there's so much demand and increase in spending for I guess most of the world. If you're locally, you can just look at ST Engineering, so they're doing quite well. But yeah, so hope that helps to answer your question. I'm going to hand it over to Glenn for some more. Thanks.
Yeah. I'll take on a few of the bank stocks. Bank questions, sorry. Yeah. So, John, maybe you can move back to the slide about the banks, the asset repricing. That slide. Yeah. Someone's asking, for banks, what does asset repricing mean? Yeah. Sorry, I didn't want take too much time. So, just to clarify, this is some of my own some of my own calculations and how we look at it, right? So, how I got this figure here is basically for asset repricing, is just taking the asset yield for this quarter, minus off the asset yield in the previous year's quarter, so year-on-year difference. So that's how I get the repricing difference. And for cost of funds, similarly, year-on-year difference. So we can see, how much change was there, and whether or not there is a difference. So that's how I look at this asset repricing. Asset yield repricing, which is why we can see, if you look at the orange line, the difference year on year is huge, right? Because of the rate hikes. But you would think that the cost of funds would be similarly, high, right? Because this is a difference kind of thing. It's not asset yield over cost of funds. So you would think that the difference would be the same, because if rates go up, why aren't deposit rates also going up, right? If they can charge this much, why can't they give this much as well? But you can see that the banks are, I guess, a little bit sneaky, in that sense, where they hold back on giving higher deposit rates, but yet they charge you more, and which is why they are able to, have this surge in the NIMs. But then it sort of backfired, because what we can see later on, after the initial, the few quarters, 4 or 5 quarters that they had this huge growth, was that they couldn't increase the rate, the loan yields or asset yield anymore, but they had to continue increasing their deposit costs, right? Because then they had to retain the customer. Then this backfired for the next few quarters, and currently we are seeing sort of this parity where the difference is minimal, right? It's almost zero, I think, 0 point something, 0.1, 0.2, 0.1 is even less than 0.2. So now they have sort of reached an equilibrium where the difference between the asset repricing and asset cost of funds repricing is quite similar. So, which is why we are also expecting for net interest margins to remain stable going into the next few quarters, if this holds steady. Okay, hope that answers that question. If you need more clarity, you can always put in another question. The next one, John can go back to the Q&A slide. The next one is asking, why do you think Warren Buffett is selling Bank of America? That's the question I also want to ask him, ask his company, Berkshire, like why are they, selling down on Bank of America? I think there's a question on a lot of analysts' minds and a lot of investors' minds, like why is he doing this? I think there are a few theories, I would say, why he's doing that. Firstly, there are some theories out there is that taxes, he feels that it's overvalued. But I think the one of the main ones that I've seen so far is that I think if you own more than 10%, there's a reporting threshold. If you own more than 10%, above 10%, you have to file with the SEC within like 2 business days whenever you change your holding. So now they're just above, I think just above 10%, if I'm not wrong. Yeah. So if they go below that, then they don't need to file anything with SEC if they do, sell the stock or even buy back some of it. So I think that's what they're trying to do, get it below 10%. Yeah. If you see historically, Berkshire has been, they have gone very heavy into Bank of America during the GFC, during crisis. So I think that it really is a bit of profit taking for them as well. Yeah, because they gone in at the worst point, so now they're just trying to take some of the profit. That's just my best guess, I would say. There's one question about AI. Maybe I'll just touch on this a bit. If you're looking at the banks, so banks are also very heavily investing into this AI bandwagon, right? As the question is asked. So I don't think it's really it's not just the hype, right? I don't feel that it's a bubble. So for the banks wise, JP Morgan during their investor day, I think they were the only ones that came out. And then they said that they are trying to have every new hire to be trained in AI. And the main aim is to get it to reduce the mundane tasks and to save time and money, right? And I think it does work in a certain aspect if you look at even your day-to-day lives, right? If you work in a bank, all the more so because you're looking at crunching numbers. So AI will really reduce those like mundane tasks, maybe inputting figures or trying to find that figure. So the AI will help them with that. And I guess what is the biggest benefit to the bank is that it will cut costs, right? They can cut down on manpower, cut down on the man hours as well to get them to do other things that can help to generate revenue. So instead of like moving away from all these operational things. Yeah, so I think that's my view, at least on the banking sector. Yeah, I think it applies to all banking sectors, not just the US banks, but Singapore banks, US banks, every bank. Yeah, maybe the rest can talk more on that. Yeah. Let me see whether there's any more banking questions. I don't think so. So maybe I'll hand it over to the rest of my colleagues. Maybe if Ambrish is back. Yeah. Thanks.
Maybe I'll just take a few. I'll just take a few questions. Yeah, so there's a question here. There's increased tensions in the Middle East. Israel may go into war against Iran. However, the US markets are not concerned and keep trending up, especially in Nasdaq. Kindly share. And so I don't think they really care. To be honest, I don't think US investors, fortunately or unfortunately, they don't really care about what happens as long as it doesn't involve them. So yeah, I mean the Nasdaq, it's more like the S&P 500. It's just been trending upwards. It just looks fairly unstoppable at the moment. Yeah, so the short answer is that they just don't really care as long as it doesn't impact mainly their daily lives or impact the economy. It won't really impact stock market. So what are your thoughts on First Solar? So First Solar is like the name suggests, is a solar PV company. So similar to what Tesla actually does with their energy storage business. They leverage on solar energy, store this energy in batteries and provide it to your customers, either industrial or even big government. But they seem to be doing well. At least their stock price is up 50+% this year. Financials are doing incredibly well. So I saw they have 3.5 gigawatts of net bookings for the year, I believe, for all this, which is quite significant, or at least net bookings for future jobs. I think as long as you are in this solar business right now, you reach a certain scale, it seems to be fairly lucrative, especially in the US. I think where at least in the remote parts, electricity is not as stable as it is in Singapore or any of their tier 1 cities. Eh, so as a company, I think I took a quick look at their financials and they seem to be doing fairly well. Their earnings doubled in the second quarter. Looks to continue improving, at least in the near term. So yeah, I think for solar companies, they're riding quite a lot of more sector tailwinds, right? Green energy and all that. I think that's still fairly true, at least in the US. Yeah, I'm sorry, can't really give you a better answer than that, so you don't really cover it, but that's to the best of my knowledge. That's what I know about First Solar. There's another question here. Who do you think will win the election? Do you think DJT stock, which is Donald Trump's essentially his company stock, will rise if Trump wins? Looks like yeah, definitely DJT will go up quite significantly. Who do I think will win? I want to say it's quite likely that Trump will win. I think just judging from some of the maybe not so much his presidential debate with Kamala the last time, because the moderators will seem quite biased there. But not just him, his VP JD Vance also basically had a really good debate against Kamala Harris's VP nominee. But it looks like me that I think that Trump will win. Probably by a very small margin, but I think he might most likely will win. There's another question here. Everyone is hopping on the AI wagon, but I feel it's a micro bubble. How do you see companies currently adding cost and using it to bill clients as a revenue source? Also, I believe most companies also have not figured out how to add value using AI yet, and at the same time, it's a heavy expense. What are my views? Yeah, no, I definitely concur. Um, it, uh, it, a lot of companies that are developing AI really haven't figured out how to monetize it yet. A good example, actually, I think is Adobe. They have the image editor tool and all that. Uh, I tested out some of their AI tools and they are very impressive. Really very impressive, right? Technology. But they're not really charging any higher prices. So they're not really leveraging the technology or the improvements into their products yet into extra revenue. But that's one of the reasons why we really prefer NVIDIA, because it doesn't matter, whether these other companies are able to monetize it or not, as long as they keep spending and they keep building it out. That's just benefits NVIDIA, just full stop. Right? It's just a one-way street. Because NVIDIA is the one that monetizes everything, or at least they've got a head start at monetizing everything, especially in the infrastructure. And that's why we're a little bit less, I guess, less hot on some of the SaaS companies that are trying to use AI and leveraging AI, because they are just incurring more costs. On another level, for the hyperscalers that are building out capex, they are starting to see instant revenue flow through, because they're able to rent out these, I guess it's called GPU as a service, right? So they rent out their GPUs for companies to train and inference data, or they just essentially rent out the models that they already have and just generate extra revenue. So that's we're a little bit more positive on the infrastructure side as well as the hyperscalers, rather than companies that are trying to use AI to improve their products. The only exception would be the digital advertising guys, because they seem to be able to translate AI improvements into increasing revenue. Yeah, other than them, the rest of tech companies right now are still trying to figure it out. I mean, I think there are two questions here on I guess all the elections. I'll take these two and then I'll hand it over to in this meta question, and then I'll hand it over to yeah. So the question here: if Kamala wins, what are your top stock picks? And if Trump wins, what are your top stock picks? And a follow-up is, how will the US election results affect the US market? So I think you can think about it more from a sector perspective. I think a Tumblr wins the sectors that are likely to will be your clean energy sectors, because that's likely where a lot of focus will be. I think honestly, if she wins and they introduce more Biden economics, they want to raise corporate taxes, and I don't really think it'd be great for a lot of corporations. I'm not really too sure about that, but if Trump wins, likely a lot of the industrials will do well because they're trying to bring back onshoring production. So you're seeing that with the semiconductors, you're seeing that with a lot of their other their production lines. So likely production or rather industrials will probably be the top sector pick for if Trump wins. Yeah, hope that helps. Either way, based on historical numbers, the stock market continues to go up, even if a Democrat wins or a Republican wins. So it doesn't, in that sense. Yeah, so last question for me for now. What are your thoughts on Meta? Can still buy? Yeah, so I think for Meta, the business model is good. They've had a very strong recovery from the bottom towards the end of 2022. I think they were trading at that time like 10 times or 9 times PE, which is absurd value, even lower than some of your very quote unquote value stocks. But for right now, I think valuations have run quite a lot. The stock price has run quite significantly. So I wouldn't really be adding any Meta stocks, just because I think they're currently a little bit overvalued. But we'll probably have to wait for a little bit more clarity during the earnings call to see, at least to judge the pace of earnings growth and everything, to have a little bit of a better idea. Maybe with that, I'll just hand it over to Helen to answer some of the questions on C as well as Apple. Then we can go.
Yes, thank you, John. So there's one question comment on C. So C has been seeing overall pretty positive growth in all their business segment. Their e-commerce segment, Shopee, has been seeing really strong growth. Their GMV growth was 29% year-on-year in the last quarter. Their gross order increased almost 40% year-on-year. So it has been definitely increasing quite aggressively. And this is quite supported by them trying to adjust their take rate to higher. So that kind of also signals that they're actually quite comfortable with where they're at and they're not seeing as much competition as before. That's why they're comfortable enough to start increasing the monetization. And they're also doing the same story. They're trying to enhance their logistic capabilities and cutting down costs. So all that has been quite healthy. In terms of their gaming, even though their numbers do not really seem good, has been showing really strong positive trend for the last 2 quarters. If you look at their game user metrics, which is QAU and QPU, they both show very significant strong growth, almost 20% year-on-year. The reason that we're not seeing the numbers that are actually pricing their earnings is because they're trying to follow the GAAP standard. So all of the earnings is actually going to get reflected only in the fourth quarter of 2024. So very strong growth. In terms of C money has been seeing pretty stable growth. It's always 20%. Largely is pushed by the consumer SME credit business. They're still the key driver of that. So overall, we're seeing pretty healthy. Nothing that we don't really like. The only thing that we kind of worries is ever since the third quarter of last year, they're starting to pend up very strongly their sales and marketing spending, because that time is the time where TikTok trying to expand aggressively into Southeast Asia. So they're trying to fend off their competition. So that sales and marketing spend is still really high. It's still a 57% year-on-year increase. So it seems to be the new norm now. So there doesn't seem to be any indication that they're gonna rise down the number. So that's the only thing that we're kind of concerned. But overall, pretty strong growth. Nothing that we kind of worry about. I hope that answers your question. Then I see several questions on the Apple. In terms of iPhone 16 demand, I wouldn't say it's exactly negative. There has been pretty mixed commentaries, but to be honest, there's not really an official number that we can track on exactly how much is the iPhone 16 still. So it's more like speculation about people. So usually people try to speculate the numbers by looking at the waiting time when you order it online. But that's also kind of mixed depending on the country that you're in. So some country there's no waiting time at all. Some country the waiting time is quite a bit, which is why you see pretty mixed up commentary about the demand. Well, if you really ask me, I would say it's not really fair to even use that as a matrix to kind of measure the demand because that also depends on how much supply that they have. So for Apple themselves, they actually prepare more supply for iPhone 16 compared to their iPhone 15, judging by the number of chip that they order from TSMC. So the number of chip they order this year run was 90 million for iPhone 16, which is up for almost 10% compared to last year. So if you think about it, they have more stock prepared this year. So even shorter waiting time doesn't necessarily mean that the demand is not good. So right now, the only kind of official data that we do have is the CEO of T-Mobile. When he was doing an interview, he kind of mentioned that the iPhone 16 new model demand is actually outperforming last year's model. And there do seem to be a trend where consumers are actually purchasing the higher end models. So that is kind of the only official news that we have. But I would say the fact that there has been mixed commentaries means it's definitely not really, really strong demand. So there's that. In terms of the late launch of AI, you're correct. We actually kind of expected to roll in because they're going to start introducing the new features of Apple Intelligence in the last quarter of 2024, starting with US. So we kind of expect there's going to be a product upgrade, especially for iPhone. Because actually, if you look at their FY21, their Apple iPhone revenue actually grew for 40%, which is very, very significant. And that was 3 years ago. So for those people who actually bought the phone 3 years ago, we think it's probably the opportunity for them to actually convert it to the newest model. So we do expect a significant product upgrade to come in, but we expected it in 2024, but that seems not to be the case because Apple, they actually projected a 5% year-on-year revenue increase for the next quarter. And that if you do simple math, because their services is growing double digit, and has been growth in iPad sales as well. So that kind of point down to flat or potentially even negative growth for their iPhone. So definitely the anticipated cycle is not going to come in 2024, but we're still expecting it to come in FY25 or FY26. It's definitely going to be slower than expected. So I hope that answers your question. I'll pass my time to the rest of my colleague.
Yeah, thanks, Helena. Take a few more before we hand it over to Zain. So this question here, you expect a strong finish to 2024. What do you expect for 2025? What should investors look out for as guides to inflection point, especially when the US market tends to fall after rate cuts? Yeah, so I'll probably say two things. The first thing, monitor the labor market closely. I think right now the market's quite sensitive to the data points coming. Either it's job opening, unemployment, and all that. So if you start to see improvements there, then obviously that'll be positive. Secondly, you can look to earnings amongst the other 493 companies in the S&P 500. So generally, if you start to see healthy earnings growth, margin expansion, then at least I can give you an idea for 2025 whether investors will be positive or not, and whether the market will continue to rally moving forward. So I hope that helps to answer your question. There's another question here. Would TikTok take away a significant portion of ad revenue from Google, thus making Google not too attractive? Short answer is no. I don't think they'll take away any significant portion of ad revenue. Main reason is because they're predominantly a short form video platform, and typically short form video hasn't monetized as well as traditional either long form video or just static search advertising or static advertising. And at the same time, Google is also really ramping up its YouTube Shorts, which is a direct head-to-head competitor for TikTok. So I don't think there'd be any significant impact for especially if TikTok is going to be banned in the US, and just be more positive for like, do we feel that the US has not really addressed the issue on the fiscal side and servicing the interest, which could keep inflation higher for longer? Therefore, the US would keep rates higher for longer and couldn't cut. Yeah, so I don't think that will really stop the Fed from cutting rates. What's likely is going to happen is she's going to do the same thing. They're just going to issue more treasuries and increase the rate so that they can. It's kind of like a deep Ponzi. They just they just kind of issue more notes to pay off the old notes, and just keep servicing and keep growing their debt. I mean, that's my personal view on it. I don't think until that stops, it is very difficult to predict where the stock market go. If anything, it'll just continue to go up and up and up. Yeah. Sorry, that's a very basic answer to a very complicated question. There's another one here. Do you think the US stock markets have the chance to break the highest records again for S&P, Nasdaq, and Dow Jones by the end of 2024? What would be the valuation by then as compared to historical average if the markets do hit peak again? So, I mean, for the S&P, they're already basically at the peak. They're already at all-time highs. I think they made it days ago. But yes, I think definitely I do believe they'll continue to make all-time highs up until the end of the year, 2025. Zane mentioned earlier the fourth quarter target of about 6,000 for the S&P. Right now we're at 5,700. So that's not really that much more. In that sense, in terms of the evaluation on a PE basis, it's difficult to say because you're likely going to see some upward revisions in forward EPS estimates. So in theory, your PL forward PE could remain the same. And because earnings continue to grow, the stock market is going to continue to go up and up. Yeah. So hope that helps. Last question here, and then I'll head it to Zay for wrap up the TA. Comments on NVIDIA growth and the possible shareholder sell down again. It's running to 140, 150, and all of a sudden dropped to 110 because of a major shareholder selling. It's been going at low price. So target price 155, is it achievable? Yeah, so actually, for NVIDIA's growth, well, at least fundamentally, we don't see any issue in the near term or even medium term. The shareholder selling down, I think you're referring to CEO Jensen Huang selling his shares. I don't think that really has a significant impact. I mean, the market is like 3 trillion, sold down like a few billion. So I mean, it's very minor in terms of market cap. It was more to do with negative news coming from the other chip manufacturers and other semicon guys like SMCI, I think ASML. Just more regulation on China, putting a little bit of doubt in investors' minds. I mean, right now it's like 132. It's going to open at 134. So that's maybe another like 15%. It'll hit 155. So definitely very achievable. We could see if it goes for a little bit of a run today, we could see it reach all-time highs. So definitely in terms of fundamentals, we don't see any issues for NVIDIA. Like I mentioned earlier, all valuations on a PE basis is also quite attractive. So there's definitely room for more for the stock to run up. Yeah, okay. I think that's all the questions that I'll take for now. Maybe I'll hand it over to Zane to finish up with the PA and then pass it back to Matsu. Thank you.
Okay, thanks, Jonathan. I'll just start sharing my screen for the TA. So first question is on AMD. So I think AMD will likely continue to trend higher. So recently we've seen that this previous 162 previous resistance level has continued as support and we're still seeing this bullish trend continue since start of September. So with that, I think we're likely to see this price gap being filled at 175. Then likely to retest this previous support breakdown level at 179 next year. So it's still overall still a quite healthy trend for AMD. As for NVIDIA, I think recently they've shown some strength as well. Price actually broke above this downwards resistance line in blue. Also, currently is above this previous range consolidation resistance at 130. So with that, I think we're still likely to see some upside for NVIDIA in the near term to actually test this 136 level. It's the next resistance, and followed by the previous high close to 141. Okay, then for Intel, I think Intel is still overall still looks like there's some positive signs currently. Since price broke out of this range consolidation resistance at $22, it's continued to help as a support. So that's a positive sign. I think with that, we're likely to see price do a bounce to retest the recent highs close to 2460. Then afterwards, the next resistance level is likely to be around 2750, which was a prior support level back in May last year. And as for the question on Samsung, I think Samsung overall still in this downtrend. Recently broke below this around 65,000 previous support level due to act as resistance. So overall, the downtrend momentum is still intact. I would say we might see some drop maybe towards 57K, the next swing low level. Then we might see some bounce again. But overall, the downtrend is still intact for Samsung. Okay, then I'll move on to some of the banking questions. So first one, Bank of America. Bank of America, I think overall still in a bit of a consolidation, mainly between about 38.20 to about 40.70, 40.80. I think nothing much for now unless we see a breakout of either direction. And above this 40.80 resistance, the next level is likely to be at 41.70 to about 42.50. And meanwhile, to the downside, if we see a breakdown below 38, we could see maybe 36.50 again. Then for Citigroup, I think Citigroup some strength. Looking one of the stronger ones of the banks currently. We've seen price of multiple retests of resistance of 62.80 about there, and forming higher lows in progress and possible breakout over here. So I think price could hit higher in the near term to actually retest this next level of resistance close to 65.30. Okay, then for Wells Fargo, I think some meeting a bit of resistance from this downward resistance line in blue currently around the $58 level. 59 over here is also a previous swing high resistance. So we might see some sort of a small pullback in the near term, but I think support could come in again at this 56 level, which was the recent resistance level. So maybe some consolidation over here for the time being. Okay, then as for JP Morgan, I think it's doing a bit of a consolidation recently, but the positive thing is that price looks to be holding this prior resistance at 209, 210 as a support level. So I think if it continues to hold this, it could trend higher. If you can break above the recent resistance at 214, the next level of resistance could go towards is around 218. I'll just answer the last two questions on the bank since it's 9 already. For US Bancorp, I think it's a bit of a consolidation currently. Between about 44 to about $46. So I think if we see a breakdown below this 43.70 level, we might see a little bit of downside towards about 42.50 to about $43 next. But if we still see a breakout of 46, we could see maybe a retest of close to 47. Overall, still quite range bound for now. Okay, and the last one is on Bank of New York Mellon. So overall, I think for this is one of the strongest in the among the banking sector currently. Still trading outside of the main uptrend channel, and price just came back to retest the recent swing high resistance at 73, also at the all-time high. So I think bullish momentum still likely to hold, likely to see new highs ahead. Looking at in terms of the current trend. So I think that's all for me. For the TA questions, I'm unable to answer, but due to time constraints, you may feel free to post them in our P3 community group, and I'll take it from there. So I think that's all. I'll hand it over to Fanzi to close the session. Thanks.
All right, thanks for all our speakers for the presentation and the interactive Q&A. So we have now come to the end of the webinar, and I thank all of you all for joining us this evening itself. And I hope for those that are going to trade soon, best of luck for today trading. Right, for the session just now, we'll be uploading the recording on the PhillipCapital YouTube channel. Right, so you may also view the recording of the webinar on your own time. Right, so we also do have many other interesting webinars going on almost every other day. You can view the full list of the free webinars or seminars on our website as well. So do take your time to fill in the survey so we can actually improve your experience with us in future. Right, so you can scan the QR code on the screen right now to actually give us your feedback to see how we can improve on the session. Okay. You can also join us on our investing communities to get the free access to the full research reports and discussion on or technical analysis on the stock itself. So there's various different groups for each of the thematic. So you might actually join the groups that you're interested in. So like what Jane mentioned, if you have missed out your questions just now, you can actually post your question on the technical analysis group itself. He can also share his views over there. All right. So once again, thanks all of you for joining us, and hope to see you tomorrow as well. And tomorrow and Friday, we still have our last two sessions for the strategy and stock pick. So we do have our speakers from the Indonesian market first tomorrow, and Friday we'll end off with the Japan market as well. So stay tuned and take care, and have a nice evening ahead.